Nifty and Sensex end Friday at three-month highs. Financials led the market higher, with the Nifty Bank ending at over one-month highs. For the week, the market ended higher for the second time in a row. The Nifty Bank ended with gains of 9%. I mean, it's been a frenzied move, not just here in India, but around the world, especially in emerging markets. We'll take stock of what happened over the last 5 trading sessions. You're with us here on this wrap-up show of the week, but more importantly, as always, on Taking Stock, we prepare you for what lies ahead. I'm Prashant. With me, as always, my colleague Surabhi Upadhyay. Hi, Surabhi.
Hi, Prashant. What a week it's been, right? I mean, 6% solid gains coming in for the Nifty once again, about 8% for the Bank Nifty. The rally continued relentless. Well, we've got lots of opinion lined up. Today, we will be joined by Manish Sonthalia of Motilal Oswal Asset Management. He weighs in on the market's current positioning and, I mean, how do you look at portfolios from here on? And then, of course, a cross-section of views, including Ramdev Agrawal himself and Ashwini Agrawal of Ashmore Investment, also Kenneth Fisher of Fisher Investments. But before we get to all of that analysis and that opinion, let's just quickly rewind back and take a look at what happened this week. Well, the rally simply continued. Global markets continued to be in fine spirits. And back home here, liquidity was gushing through several days of 4-digit FII buying. And that ensured that the Nifty cruised well past 10,100. In fact, the Bank Nifty also had a very, very smart rally. And we saw contribution coming in from that index as well. And just a couple of points. The commentary from the corporate side has been very positive. Most of the companies that we talk to are talking about higher capacity utilization levels. So the unlocked trade, or the reopen trade, call it what you want, that continues. And it's very, very evident in a lot of stocks which were originally beaten down, including some of the auto names as well. Then look at what SBI said. I mean, a case in point. Nothing negative, no nasty surprises on the fourth quarter. The bank sounding very, very confident when it comes to provisioning, handling the moratorium issues, and also capital requirements, saying we don't need to go to the government or to the market. So those were reassuring words that were coming in from large corporates. And not just that, I mean, the good news continued for Reliance, with Jio Platforms getting in yet another marquee investor, this time the Abu Dhabi Sovereign Wealth Fund. So it was really raining good news. And speaking of rains, the good news is that the monsoon has also arrived in Kerala ahead of schedule, of course, and Mumbai managed to escape without any major damage from the cyclone. So largely speaking, Prashant, I think it was a positive week. I'll come back to you to talk about sort of what lies ahead, the triggers ahead at these very heady levels. But let's just quickly recap all the stock-specific action with Nigel. Nigel.
Well, what a week it was. The Nifty Bank, and the breadth of the market as well did very, very well. It seemed like the bears, they went on a vacation, because we were looking at the headline indices. Well, there were big gains. And keep in mind, the Nifty Bank, the kind of bounce we're seeing out there is a big one. The breadth of the market participated as well. But if you're looking at these details, well, you don't really understand the way the market rallied in the past week. Let's run you through first some of those Nifty gainers. There was a combination. You had some of those, auto stocks, metal stocks, even financials and banks did very, very well. The biggest gainer was the global-facing theme. That was Tata Motors was up more than 25%, or a couple of metal stocks in there. You had Titan as well that was in there with a gain of around 11% approximately, and Vedanta up 14%. From the IT pack, only Tech Mahindra made it to the list. That was sitting with a gain of closer around 9% odd. Few losers, some of those that were defensives and, we did see a lot of buying when the markets were looking a little bit wobbly. Well, they came in for profit booking. So Nestle, you had Asian Paints, Dr. Reddy's as well, more or less flattish. So they were relative underperformers when you have the Nifty up closer around 6% approximately. But hold your breath. Here's where it gets very, very interesting. Vodafone was up closer around 60% on a small base, but that stock did rally big time. PVR, off to the movies. That one was, in fact, was up closer around 40% approximately. And throw in there a couple of these banking names that did bounce up as well. IndiGlobe Aviation came out with a good set of numbers, better than what the street was working with. And now everyone's factoring in that maybe, in fact, the economy will restart and people start flying again. So that as well was up in the past week itself. In terms of losers, you had Colgate that was under pressure, Marico, as well as InfoEdge. So it was a good week. It seems the bears were on vacation. Back to you guys.
Nigel, thanks very much for that. I mean, actually, the only cyclone or storm was in the markets, right? I mean, and in a good way, because it just dragged everything up and how. And Nigel just pointed out the returns. I'll keep this very short. I mean, this is an emerging, synchronized move across emerging markets. And why just emerging markets? And I put this data out yesterday. From the 26th of May to today, markets have rallied between 10 to 15% in emerging markets and between 7 to 10% for developed markets. I mean, this is big across the board. And you've got also other asset classes which are supportive. I'm talking about oil, for example. And what happens when oil rallies? Commodity currencies and other related asset classes also, other related assets rather, also find support. So that is the other point. The underlying big theme, of course, is central banks not unwilling to let go and preventing every dip which may happen. I think we got a reminder with the ECB yesterday, which did more in terms of the pandemic asset response program compared to what was expected out there. So I think it was a timely reminder that central banks will continue to support markets. I mean, so as I said, I'm keeping it very, very short now today. But in terms of Nifty, we closed at 10,140. I've put this level up many times in the past as well. The logical next level that the Nifty should get to is basically the 61.8% retracement of the entire fall from the February highs to the March lows, and that stands at about 10,450 or so. So there is still some distance away, but given the momentum in the market, I think very, very possible that we get to those levels before, and that's not very far away before we discuss another leg down or continued move higher. Let's throw some of these points to Manish Sontalia of Motilal Oswal Asset Management Company. He's with us on the show right now. Manish, thanks very much. Good to have you here. What are you making of the continuing big move across markets?
Prashant, I think it can be the beginning of a new bull market rally. Precisely FY21 numbers is through at 10,000 odd on the Nifty. So I think markets now are looking at FY22 numbers and trying to price in sort of growth that is anticipated in FY22 and the fall in prices that we have seen over the month of March, April and May. So from that point of view, I think pessimism is still looming large. In that backdrop, I think markets are underpriced from an FY22 basis. It could just be the beginning of a new bull market rally.
Beginning of the new bull market rally. Okay, Manish, those are words that sound quite optimistic. Now, let me ask you this. The broader market has also started showing signs of, life. We're seeing huge moves on a lot of stocks. Nigel mentioned some of them, including consumer. Is this a time for a shift in the portfolio? This whole attachment that the market had with the pharmaceuticals, some of the defensive names, staples. Is it time to change the levers?
See, globally, countries are opening up. We are also seeing in India move away from a lockdown to an unlock mode. So I think markets and economies are moving away from a risk-off mode to a risk-on mode. And given the pent-up demand in the system, you're going to see some sharp spikes up in volume. So let it be automobiles. What we are hearing is that two-wheelers are flying off the shelves, in cities where the lockdown has got opened up. Of course, banking as a sector will see some pain. We anticipate some 5% sort of a GNPA for FY21. But I think, it's a risk-on trade and all the leverage beta plays are going to see a leg up. And probably FY21, the NPLs, the meager earnings or fall in earnings would get discounted. So it's a mood shift away from a risk-off trade to a risk-on trade. Sectors which have broadly done well over the last 3 months may see some sort of an hiatus. Sectors which have seen a very sharp correction on the downside can see a leg up going forward.
Okay. So, Manish, now let's also talk about the largest part of the market, financials, because the rally has been led by a recovery in these big banks and even the bigger NBFCs. We've heard SBI today. What's your take? I mean, can they weather the storm, and how would you look at some of the banks now?
I mean, SBI reported some stellar numbers, I would believe, from Q1 FY18, 6% GNPLs has come down to 2% to 2.2% types, And if you look at the Morat book, it's at a level with the best in the industry, like 23% book under moratorium. We have seen Axis Bank at 4%. We have seen HDFC Bank, Kotak Bank at 26%. So best in class in terms of the credit underwriting over the last 2-3 years. NPLs are very broadly under control. Only one flip side, the net interest income came slightly on the lower side. I think the decrease in yields on the loan book is something we got to understand. But apart from that, the valuations, the numbers, fantastic set of numbers, I would believe. This bank should be up for a re-rating. And in that backdrop, I think, markets are wanting to just overlook FY21 numbers. But the exact picture of the GNPAs will only be known in the third quarter. Broadly, Morat is there till August. So unless the numbers come out for the quarter ended September, we'll get to know that. And today banks are just working on statistical models, trying to figure out of consumer behavior what sort of an NPL should come through. For the banking system as a whole, I think NPLs, gross NPLs should be for FY21 at around 5%. In that backdrop, I think prices have got hit very hard. And if that was the number to come through and we see improvement, then banks would have seen their worst in the last 3 months that we already did.
Manish, all of us will be overjoyed if this is the start of a new bull market, and it may well happen. But we've got to be able to reason it through, in a reasoned way, right? Are you saying that there is so much liquidity that will find its way irrespective of earnings growth or anything? Because at the end of the day, you take any period in time over the last 20 years, take 5 block periods and compare market returns and earnings growth, and it broadly would gel, right? Earnings growth over the last, 5 years basically has been about 6% or so. And now it's not going to get any better. Right? In 21, it's people have been calling for 20% earnings growth for a while now, and now we've been hit with this crisis. I think it would be okay to say that, the bar just went higher to get back to very strong earnings growth. Where is this new bull market theory coming from?
So first is the ample amount of liquidity sloshing around in the global system. Every day you are looking at central banks printing tons and tons of more money. Yesterday, ECB, etc., decided to pump in again some mind-boggling numbers of currency. On the other hand, you have interest rates that are coming down. Even in India, I think the 10-year GSEC yields will settle at around 5.5%. Broadly, corporate earnings and market capitalization, either of stocks or the market as a whole, will gel, in tandem. But I think there can be one-offs, and FY21 due to coronavirus incident should be looked upon as a one-off. FY20 numbers was exactly 0% sort of a growth. FY20, we are still in the middle of the fourth quarter. So FY21 will see a degrowth when we compare it to FY20 numbers. It was supposed to be a 20% sort of a growth. But given the pandemic and only resumption of normalization of economic activity would start somewhat from the third quarter, moving into the fourth quarter and beyond, I think it would be good that we anticipate a degrowth in earnings on the Nifty in FY21. 20p multiple on the upside, 15p multiple on the downside on an FY21 basis. You get 7,500 and 10,000 broadly. 470 is the EPS numbers that we are working with for FY21. Now, all of that has got priced in. Because of the ample amount of liquidity, markets would want to look at FY22 given the base of FY21. And because corporate profits to GDP is now less than 2%, the slack in the system is so high, expectations are so low, and there's ample room on the upside to be surprised. Given the low base of FY21, I think that can be an eventuality. And in that backdrop, markets are just pricing and stocks are just pricing in a bit too much of pessimism currently as we speak.
Okay, Manish, thank you very much for the views in the call today. We're going to remember this one. Indeed, it'll make some people very, very happy, or a lot of people very happy if this is the start of a new bull market. Thanks for joining in. Have a great weekend. and we will connect with you again. Speaking of bull markets, the US market has had a relentless run as well. In fact, it's the best 50-day run. I think, Prashant, you're looking at data. Best 50-day run in its history. Tell us more.
You know, Surabhi, Manish is forecasting a new bull market. I won't do any such thing, but I will look at history. I think if Manish is watching, he'll be happy to note what I'm presenting here, which is essentially the fact that, by the way, this is the best 50-day run ever for the US market, the S&P 500. These are those periods, 4 periods I've taken. When the, leading up, 50 days leading up to 8th of December 1998, the market did 24% and so on and so forth. May 2009, September 2009, June 2020. These were the returns, 50 days leading up to these dates, right? Look at returns 1 month later, tepid. Look at returns 6 months out, well, a little better. But look at the 12-month return, right? 20% in December of 1998, 23% in May of 2009, 5% in September of 2009. What will the numbers be here? 1 month out, 6 month out, 12 month out. I mean, I think, Manish and many who are expecting this to kind of continue to power ahead, it's a useful statistic. I mean, facts and figures don't lie, but it is also true that history does not repeat. But it could give you an indication of indication that you should temper your bearishness or bullishness. Either ways, the average of 8 episodes. I'm only presenting 4 for the sake of brevity here, but the average of 8 such episodes, starting from 1975, are those numbers. On an average, over last 8 episodes, right? The S&P 500 has done 17.5% more on top of, compressed 20+ returns. So that is the evidence. I mean, as I said, facts and figures don't lie, but this is the evidence that I wanted to present. And of course, I mean, if the US market does something like that, I mean, it's very hard for other markets, even with idiosyncratic factors, problems in the local market, etc., to stay very much behind. I mean, it is usually a boom in liquidity which drives markets higher, and other markets will follow if this were to happen this time around as well. Back to you, Surabhi.
Okay, well, Prashant, very interesting data over there. Let's see how this goes. But for now, we have to take your leave on this edition of Taking Stock. It's a wrap from Prashant, me and the entire team. But as we say goodbye, hear out more opinion that we gathered during the course of what was an extremely upbeat week for the markets. See you again on Monday.
There is no panic. I don't see the panic which is fearful. What Buffett was saying, that our telephone is not ringing. So I think that panic is not there, whereby people have been completely staggered and they're so scared. And I think there's something to do with the act of God. I mean, they're not blaming anybody. It's just a done thing. And hence everybody is just shell-shocked, frozen, and they're taking it whatever is coming by. Don't time the market, so I don't time the market. I clearly don't time the market. And I'm lucky that I have not timed the market, because you can see how unpredictable is the market right now. I have been blessed because of this, that I've not done anything funny. I remain 100% invested.
The lifting of the lockdown has raised hopes that we might, get back to normal in the next 3 or 6 months. So from that perspective, the market is trying to price in a more normal economic environment sometime down the road. Also, what's happened is that if you look at the last 10 days, you've seen very large block transactions go through. Bharti Airtel raised $1 billion. Then Kotak Mahindra Bank, through primary and secondary put together, raised $2 billion. Reliance rights issue has been very well subscribed. So I think the message that the market is getting is that there is enough liquidity out there. So if you have a business model that you can offer some confidence about, capital is not a constraint.
So this is a different kind of a bull market, but it is a bull market, in my opinion, for many reasons. One of them is that it is exceptionally rare when you look at the very broad global or US-only market, not smaller subset markets, to recover this much of a decline and not move on to new all-time highs. This is a new bull market, but it is both a bear market and a new bull market that acts more like an oversized correction than it does a conventional bear market and bull market. And I believe that's one of the reasons that it's been fooling so many people.
I would actually be happy if the market does not do either, does not get to new lifetime highs and does not break the March lows. I think that's the best working view for the next 6 months, because I'm pretty clear that this is a period of time correction. I think there could be some more juice in this rally, but the number which I'm working with is about 10,160. And I want to take you back in the month of March, in the middle of March, it was around this 10,160 level that you saw a lot of congestion. And that's probably the reason yesterday and possibly the attempt today, could find some selling pressure around that mark. But once 10,160 gets taken out on a closing basis, clearly it will lead to more upside towards 10,320 and possibly 10,700.